Assalamu alaikum friends, welcome to question number 27 of SBR revision kit, and this is also a question of September-December 2019. Okay, the reason why I have chose to do this question, I still didn't finish question number 22, 3, 4, 5 and 26. Those are pending, but before that I thought of doing this quickly because there's a issue which is relating to which is very latest, that is cryptocurrency. How cryptocurrency should be valued or measured or recognized. So that's the reason why I've taken this question, and also it's the latest question. Okay, so let's start. And before reading the scenario, I'll be reading the requirements. But before reading the requirements, also I'll be just skipping through the case by just going through the subheadings. So it gives me an idea that what are the standards that I need to focus on. For example, here it's revenue. So I know it is IFRS 15. Okay, a sale of 3-year license. Next, Clay Music Company valuation and revenue. Okay, but don't just assume that it's only IFRS 15 only. No, inside that when you read there will be some small other standards also. Okay, valuation and revenue. Looking at this, I cannot know which standard it is. I only know it's IFRS 15 till now, because valuation of what, we still don't know that, right? Investment in 4D company, pension plan, so this is IAS 19. A student was asking me yesterday that actually he or she commented on my YouTube channel that he or she didn't he or she was doubting whether there's a question on IAS 19. What is the use of studying IAS 19? They didn't see the question of IAS 19 in the past paper. So here's that question, right? I hope you are seeing my video. So this is the question of IAS 19. You do have a question based on IAS 19, right? There will be a question on IAS 19. Now, coming to the requirements, and this is a 25 marks question from your section B. So advise the directors of Digiwire company on the recognition and the measurement of. Please understand and means there are two things, recognition and measurement. Recognition and measurement are two separate things, okay? First it is recognition. Once it is recognized only, we talk about measurement, because if something is not recognized, there's no point of measuring it also. So first step is recognize, then you measure. First, Clay Music Company shares received as revenue for the sale of the 3-year license, and how they should be accounted for. Clay shares received as revenue for the sale of. Okay, how you have to recognize and measure when you're recognizing it as a revenue, when you're receiving shares and you're recognizing it as a revenue for the sale of 3-year license, and this is the first requirement, and then how they should be accounted for in the financial statements for the year ended 31st December 2006. Not just recognition and measurement, but how in the financial statements it will come. Remember, whenever this question comes, how they should be accounted for in the financial statements means they are asking you where it will be debited, where it will be credited in the statement of profit and loss and other comprehensive income, as well as statement of financial position. That's the meaning of how they should be accounted for in the financial statements. Second, royalties, which Clay Music Company has agreed to pay in respect of the 3-year license in the financial statements for the year ended 31st December 2006. That means how it should be recognized and measured. Okay. Your answer to second part of A should demonstrate how recognition and measurement of the royalties is supported by the conceptual framework for financial reporting. You should know how to link recognition and measurement from a specific standard to conceptual framework. You should know this. This question will be asked in SBR no matter what. It could be asked in any question. Question number 1, 2, 3, 4. Don't ask me which question it will come. And it's for 9 marks. 9 marks means together it's for 9 marks. Okay, both A and B. We don't know exactly how many marks for the first and the second. Together, for requirement A, it's 9 marks. Coming to requirement number B. Based on the IFRS, advise the directors on the following. Okay, so section B is more like question number 3. This is, I'm assuming. It is more like recognition and measurement, more like based on specific standards, IFRS standards, advise directors what they should do. So section B is more like that. So there are three issues. If you see, all three are together 9 marks. Okay, it's not that separately. It's not only that this one is only 9 marks. No, no, no. All these are 9 marks. So you should allocate your 9 marks equally among these three. Definitely some might require more marks than the other. Okay, it could be 333 or it might change. First one is, see here they told based on the international financial reporting standards. They didn't tell you which standard. You should know which standard it is. You have to advise the risks on the following. First one, classification of investment which Digiwire has in 4D company. That means we don't know which investment they have. Okay, it could be subsidiary, it could be associate, it could be joint venture, it could be joint operation, it could be financial instruments. We don't know what it is. We have to see the case study for that. Okay, second, derecognition of the assets. You should know derecognition also, the way you know recognition. So derecognition of the assets exchanged for the investment in 4D company. Okay, and also, and always look for this word whether and is there or not. The moment you see and means there is another requirement for that. Any resulting gain or loss on disposal. When do you derecognize asset? When you have disposed it. So when you have disposed it, you will be having some gain or loss. So that gain or loss you need to recognize as well in the financial statements of Digiwire at 31st December 2006. And third one, where the cryptocurrency, this is the area where I want to take your focus upon. Very important because it's something new also. So definitely you can expect a question on this for your September 2021. Whether cryptocurrency should be classified as a financial asset or an intangible asset. Your answers should also briefly consider whether fair value movements on the cryptocurrency should be recorded in profit and loss account. See, whenever they say your answer should include, that means you have to include it. It's not an option that you want to include, you include. No, it has to. Because for that you are getting additional marks to include that in your answer. First one is to classify financial asset or financial intangible asset. Second one, fair value. Where will it be recorded? Should it be recorded in profit and loss account or other comprehensive income? Coming to requirement C. Explain the reasons behind the issue of amendments to IAS 19. Okay, what was that issue of the amendment? With regard to plan amendments, curtailments, and settlements, and discuss why the changes of the calculation of the net interest and the current service were considered necessary. Sorry, changes to the calculation of this and this were considered necessary. Now there are two requirements. One is the changes of net interest and current service. The other one is why, the reason why there is an amendment to IAS 19. This is the current issue. Why it is amended. Okay, for this you need to go through the changes in your syllabus. In your syllabus there are under that summary of changes in syllabus. It's there that there has been an amendment to IAS 19. Then exactly you will know what is this amendment and why. So your purpose is to explain the reasons why it has amended. I have just recently made a video. So the SBR changes in the syllabus. So make sure that you go through the video. Okay, what are the changes, to know the changes, because on the changes you will know the current issues and all. What are the issues and what are the changes. Before going to the exam hall, make sure that you go through that syllabus change. Okay. And the last requirement, advise the directors of Digiwire the impact of the amendment to IAS 19. What could be the impact of this IAS 19 on the Digiwire? And also, sorry, what could be the impact on the calculation of the net interest component and current service cost? Both. You have to show the impact for both. Okay, this one as well as this one. 4 marks. So it's 3 and 4 marks. Okay. Total 25 marks. Section B questions are 25 marks. Both. Okay, both question number 3 and 4 are 25 marks, and in question number 4 you will be having 2 professional marks. So I'm assuming this is question number 3, because if it was question number 4 they might ask you you would have the 2 professional marks here. So this is question number 3. So now let us go through the answer. So we are first dealing with the revenue recognition. How it should be recognized, how it should be measured. Okay, let us just wait. And how they should be accounted for in the financial statement. 3 things you have to answer here. how it is recognized, how it is measured, and how in the financial statements it has to be accounted for. So 3 marks, right? I can appoint 3 marks for this. So how are you going to start this answer? Let's say now you're blank. You went to the exam hall. You have been asked this question. How are you going to attempt this question? You start by identifying the standard. If you have correctly identified the standard, 50% of your job is done. And the rest 50% will be done if you know how to apply that to the scenario. So the standard is IFRS 50, correct? So according to the standard, how it should be recognized, according to the standard, how it should be measured. That's what you need to write first. Okay, keep it very brief because only 3 marks. Don't write paragraphs and paragraphs of all the 5. See, don't make this mistake of writing all the 5 steps of revenue recognition, starting from 1. Recognize contract, transaction price, determine allocation. No, please. They will never ask you to do all that. Those might be asked in the foundation level, not here in the professional level. Professional level, only part of it you need to apply in your scenario. This is a scenario based examination, not a knowledge based examination. So IFRS 15 requires what? What is it? First of all, you need to understand what type of is it a good? Is it a service? What is it? It's a sale of a 3-year license. So let us read it. Okay. Digiwire has agreed to sell Claim is a company and unlisted technology to unlisted technology startup company. Okay, so this is neither a good neither a service. Like it's not normally how we send like we sell us goods or sell computers good like that or sell services after service like that. It's nothing like that. Here they are selling unlisted technology startup company. They are selling a company. Okay. Sorry, they are not selling a company. It is a company, unlisted startup technology, which are selling 3-year license. I'm sorry, I missed that comma. So a 3-year license. Okay, to sell Digiwire's catalog of classical music to the public. This catalog contains a large selection of classical music which Digiwire will regularly update over the 3-year period. All those things are not so important. Classical music, all those things. Okay, what's important is it's a 3-year license. Okay, as a payment of the payment is very important. So as a payment of the 3-year license, Clay Music has issued shares. You see, how did they give that payment? It was not in cash. They gave it in terms of shares. The shares to Digiwire equivalent to 7% shareholding. Voting rights attached to the voting rights are also attached to the shares. Digiwire received the shares in Classic for on 1st of Jan 2006, which is the first day of the license term. Digiwire will also receive a royalty of 5%. There's a separate requirement on this royalty, okay? So they will receive a royalty of future sales of Clay Music as additional revenue for the license. So before that, let's just so let's read this. Claim is valuation and revenue. You need to read this as well because it's related to revenue and all. On 1st of January 2006, Claim Music was valued between 4 to 5 million by a professional valuer who used a market research approach. Market-based approach. The valuation was based on the share price of the controlling interest in a comparable listed company. So how did he base the valuation on? Based on a comparable listed company. Correct? But look at here. You are an unlisted company. That was a startup technology. And here they are comparing it with listed company. So do you think that valuation is fair enough? You need to do adjustments to that valuation, right? Next, for the financial year end, sales of classic music was 1 million. At 31st December 2006, a further share valuation report has been produced by the same professional value which indicated that Clay Music was valued in the region of 6 to 7 million. Here it was valued 4 to 5 million. Here it increased to 6 to 7 million. It's quite shocking. Right? Looks something is not right. Anyway, let's read the answer. So how, according to this, it requires what? Remember, you have to be specific to the scenario only. According to the scenario, you have to adjust that IFRS 15, how you have to apply it. Here, the question is not about how to recognize revenue. We'll come to that later. But here the question is, look at the consideration. They are paying in terms of shares, not cash. So here it's a non-cash consideration that has been received. So how do you recognize this? How you measure this? Because cash, we don't have to measure it. We know. If it's 5 million amount of cash we have received, revenue, you recognize it as 5 million. But what about shares? Their value keeps changing, right? So here, since it's a non-cash consideration received, it should be measured at the fair value of the consideration received. That means the fair value of that shares at that date that you have to recognize your revenue at. This is specific to this answer. If you see in your textbook, will they say this? No, they will always discuss about the 5 things, how to recognize revenue, all those things. So this is here. This is why you have to be very alert. You have to be open-minded. You have to accept new things in your question. Anything can come. For example, this was not a normal question. Normally, we know our doubt was whether it's a good or service. If it's a service, over next question is we recognize revenue at a point in time or over a period of time. This question is different. It is not at all a cash. It's a shares that they are receiving. So how do you recognize revenue in terms of shares? Okay, you recognize it at fair value of the consideration received. Understanding? That means fair value of the shares that you have received. You are recognizing a revenue at. Now, because they told about fair value is not given to you. You have to calculate that fair value. So the next standard that you need to use is IFRS 13. IFRS 13. Whenever fair value is used and fair value is not given to you, you have to make use of IFRS 13 in your answer, okay? So now, fair valuation of shares in an unlisted startup company is problematic. Did you see how they are linking to the scenario? Your company is what? Unlisted as well as a startup company. Here you cannot use fair valuation of shares. It's problem here. Because you will not get a fair value for your unlisted company. You will get a fair value if your company was listed. Then there's no issue. You compare and then you get, but not for unlisted. So how are you going to use? That means you have to value now. You cannot depend on the valuation that you are given. So however, IFRS 13 gives advice on how to measure the unlisted shares. Yes, unlisted shares also you can measure. IFRS 13 gives you that advice. How? So the next that you need to write in your answer, always, whenever you have to calculate fair value, which is referring to IFRS 13, that means fair value is not given to you. You have to calculate, make use of those 3 approaches, always. What are those 3 approaches? Level 1, level 2, level 3. Level 1 input, level 2 input, level 3 input. Okay, what is level 1 input? Here they are not saying, so don't describe, okay? Level 1 input is this, level 2 is the. Come on, this is not a knowledge based question. You don't have so much of time to spend, only 3 marks. So just refer it to the case study. That means when you're writing it, write it in terms of your scenario. Don't write level 1, level 2, level 3 is this, that. No. Level 1 is market approach. So you can just write, if you have not written market level 1 also, it's understood. You can write market approach. Level 1 means market approach. You are referring to the market to get the fair value. This is the most safest one and most preferred also. Okay, level 1. That is market approach, referring to the market. Such as transaction price that are paid for identical or similar instruments of an investee. That means you're looking for the identical or similar. Same as it is. If it's not exactly identical, then similar to it. Okay. Second, that is known as level 2 input. That is the income approach. Okay. You are using the discounted cash flow, discounting your cash flows. And the third method, adjusted net asset approach. Third one is the most riskiest area, right? Last resort. The preferences are not usually given to level the last one. It's the first two. If not the first, then the second. If you're not getting from the second also, then you go to the third and evaluate. Okay. But remember, it should be one of the 3. You cannot say it is provided under all the three. You don't have to give the fair value. Only one method you have to use, which is most suitable to the case study. Okay. So here, in this case, what are you going to use? In this case, market approach has been used. Now, first of all, you always have to start by saying in the case study what they have used. Whether it's correct, whether it's not, it's that will come to that later. But first is what the case study has done already. Okay, they have used what approach? Market approach, the first one. They have referred to the similar goods in the market. So market approach they have used, and also they have given that range also, the range of fair value. So make sure that you exactly say, pick up from the case study, not exactly copy paste the entire paragraph or sentence, but say that they have used market approach and the range is also given to you. So the range of the fair value is significant. If you see that fair values, very significant amount, not small amounts, based upon the professional valuation report. Based on this, so what was the range? Make sure that you write the range also. The range of the values for a 7% holding of shares would be 280 to 350,000. How 250 to 350,000? 7% of 4 million, because the range which they gave is 4 million to 5 million. So if you take 7% of 4 million and 5 million, it will be 280 to 350,000. Next, that is at the date of the contract. But later at the year end, what was it? It changed to 420 to 490, because 7% of 6 and 7% of 7 million. So it increased very much. Okay. As the fair value valuation is based upon a similar listed company and is based upon a non-controlling interest. Okay. What should you do? You have to discount it. A discount on the valuation of the share should be applied. Now you are correcting them. You have to advise them. Remember, you are advising. So when you are advising, how do you advise? Should applied. This should be done. This should have been done. You should have done this. This is how you advise to your friends, no? So when you're advising to the director also, you have to say this should have been applied rather than this. Okay. So discount, you have to discount that when you're valuing. That means your valuation cannot be so high because you are an unlisted startup company. That means your valuation should be much lower than that listed. So you have to discount that valuation of the shares. Okay. So it should be applied to reflect the lack of liquidity. First of all, you are unlisted, so lack of liquidity, and also inability to participate in Digiwire's policy decisions. You only have 7% holding. With that 7% holding, do you think you can participate in the policy decisions of the company? No, you cannot. So that's why you have to discount that valuation also. So thus an estimated value of the shares can be made which takes into account the above fact. Yes, you can estimate a value based on the above fact. So this could be a midpoint. For example, see, this is where you have to use a professional judgment in SBR. No one will come and tell you, no textbook is given there. This could be different also. Some of you might come with a different approach. Some of you might say, okay, better to take the lower range. Some of you might say better to take the higher range, but higher range is not acceptable because it's an unlisted. But in this case, they have taken the midpoint. Okay, this could be the midpoint. How? 280 plus 350 divided by 2. At the date of the contract and at the year end, again the midpoint. 420 plus 490 divided by 2. Okay. At least see, we are not saying this is perfect and all, okay? Because in SBR, some answers you cannot say exactly that this is the right answer, this is the wrong answer. No. If you give your justifications with facts, you can choose any number, you will get the marks. Some of you might say that select the lower range of it. Still, you will get the marks. We are not using the midpoint also. Remember that the revenue is recognized either over time or at a point in time. Next comes this next question that you need to ask. At a point in time, over a point in time. You know that you have to recognize revenue, but at a point in time or over a point in time. It's a 3-year license. Keep that in mind. Okay. So at contract inception, because recognition and measurement, no, you recognize at the contract inception only. So at contract inception, the shares will be recognized at, what will be recognized? The shares that will be recognized at 315,000 because you have taken this midpoint at that date. However, a corresponding entry should not be made to revenue. Should not make corresponding entry to revenue at that date. at the contract inception. Digiwire, because at that day you are not receiving shares, okay? You don't receive shares immediately when you go to the contract. 3-year license. After that license gets over, only you get the shares and then you recognize the revenue. So you do not recognize revenue at the contract inception. Digiwire company, always make reference to the company name. Always write the company name in your answer, okay? It shows that you are referring to the case study. Okay, you're linking your answers, you're applying your answers to the case study. So Digiwire retains an active role in the updating and the maintenance of the sole license to ensure its continuing value to the client. Why are we talking about this retain active role and all? To recognize revenue, control should go to customer. Control should go to customer. That's why we are seeing who has the control, Digiwire or the customer. If customer, okay, recognize revenue. If Digiwire, do not recognize revenue. So here Digiwire retains an active role in updating. He only has to update and maintain the license, okay, of sole license to ensure its continuing value to the client. As such, the customer is benefiting from Digiwire's continuing performance as Digiwire performs. What does it mean? That means as Digiwire updates, that is a continuing performance. No, they keep on doing it. As Digiwire updates and maintain the sole license, who is going to receive the benefit? Customer is going to get the benefit out of it, no? Because through license he can have that music and classical music and all. So in accordance with IFRS 15, revenue should be recognized over time. Why did we link this to this one? Let me highlight it for you. As such, customer is benefiting from continuing performance of Digiwire performance. The reason is, if it's there, if customer is benefiting as Digiwire performs anything, that means they are simultaneously benefiting. Digiwire is updating, customer is benefiting. Digiwire is updating, customer is benefiting. That shows that revenues should be recognized over time. These are the factors to recognize that revenue should be recognized over time. Yes, customers are benefiting. That's why revenue should be recognized over time. And most likely over the, what is that time? 3-year contract term, right? License is for 3 years. So any difference, remember, what about the difference between the carrying amount of the shares and the revenue recognized? Any difference between the initial carrying amount of the shares and the revenue recognized is recorded as a contract liability. You should always say whether you have to recognize a contract asset or a contract liability. That means, did you recognize revenue early in advance, or you didn't recognize revenue? You will recognize it later. Then it should have been recognized. So in this case, what happened? You recognize the revenue. So that difference you have to take it as contract liability. Okay, between the initial carrying amount of shares and the revenue recognized. So here they didn't give you that figures and all, you don't have to calculate. So you can just leave as it is. Okay, in this paragraph. But when we are coming to the next one, claim music company share valuation. Here we are going to value and do all those things. For time being, just leave here as contract liability. Now we are moving towards the share valuation. Okay. So this is still, we are in the first requirement only. Okay. We still didn't go to the royalty part. We are still in the shares only. We are now here. The valuation and revenue. So it's a 7% holding. What type of share it is? Are they going to have a subsidiary, associate, joint venture, financial instruments? What is this? So equity investments in scope of IFRS 9 should be measured at fair value. Remember, they told that fair value should be recognized in OCI or profit and loss. And also, according to this, this is IFRS 9 because it has 7% holding only. Okay. So less than 20%. So it's not a subsidiary, not an associate, not a joint venture. It's a financial instrument, that equity, that share. So IFRS 9. How are you going to recognize this? This should be measured at, according to IFRS 9 now, it should be measured at fair value. This is equity in investments, right? Equity investment should be measured at fair value in the statement of the financial position. In the statement of the financial position. Because they told the impact in the financial statements. With gains and losses on remeasurement will be recognized in profit and loss account. Normally, profit and loss account. But remember, you have to tell this line has to be there in your answer because it could be measured in another way also. If an equity investment is not held for trading, you have to write this. If not held for trading, then an entity can make an irrevocable election. Irrevocable election means you cannot reverse that election. Once it is made, it's for lifetime. Irrevocable election at initial recognition, you have to make this election, okay? To measure it fair value through OCI. FVTOCI. If you write the short form also, it's fine. With only dividend income recognized in profit and loss account. Because I have told you in the beginning, whenever they say impact in the financial statement means where it will be recognized. Profit and loss account as well as the statement of financial position and what will be recognized. So dividend income will be recognized in profit and loss. Dividend that you will receive from that equity, because equity investments if you have, that means shares. You will receive dividend income also from that. So that dividend income will be recognized in profit and loss only. That will not be recognized in OCI. Okay, only that fair value remeasurement will go. Next. Because we have to talk about the share valuation. That share comes under what? Okay. Because we have to measure it also. So the shares will be remeasured to 455,000. How? It is this 450,000. Earlier we have calculated that this is at the reporting date is 455,000. At the date, okay? Make sure that you write the date also at which date it is 455,000. So if you see the value, it was earlier 315,000 at the contract inception, and from 315,000 at the reporting date it went up to 455,000. So the difference is the gain. Okay, and this will be recorded in where? This will be recorded in profit or loss or other comprehensive income. It could be recognized here or here, either of this, because this is dependent upon that election whether you make it on initial recognition or not. Here they didn't say you anything whether that election is made or not. So make your sentence that it could be recognized here or there based on the election. That much is enough. Okay. If Digiwire fails to present the remeasurements through OCI, then let's say if they make, you have to write it because the question asked whether you have to make it in profit and loss or OCI. Then the gain will never be declassified to statement of profit and loss. If you make that election, that gain you cannot recognize in profit and loss. That means that fair value that it will go through OCI. If that election you make, the gain also you cannot recognize in profit and loss. That also you have to recognize in OCI only. So both fair value and OCI gain will go in the OCI. Coming to the second one. So that's it for first part, share valuation and revenue and all. Coming to revenue, which is related to royalty. And how, and also the conceptual framework support. So two things we need to answer. And if you are answering two things in one requirement, make sure that you are using subheading, two subheadings. Okay, so relating to royalty, same IFRS 15 only because it's revenue. We don't have a separate standard for royalty. Okay, so IFRS 15 states that revenue from a sale-based royalty. First line itself only they are saying. Okay, so sale-based royalty should be recognized how? When the subsequent sale occurs. When the sale occurs, you recognize that revenue. So at the end of the first year of the contract, revenue from the royalties can be calculated based upon the sales for the period. So this would be, now you are calculating, giving the figure. 5% of 1 million because revenue was 1 million. So out of that only 5% because royalty is 5%. So you will be recognizing 50,000 at the year end. Now we are moving to the very important thing, how conceptual framework supports here. Okay, if you see the tutorial note, this is not in your answer, this is just for your preparation. This question is quite vague about what areas of conceptual framework should be discussed. Exactly, they didn't say, right? This is an open-ended question. A student might write this answer from any aspect. Alternative answers such as discussion of the definition of the elements. Definition of the element means you can give definition of revenue according to conceptual framework. Still you will be getting the marks. Okay, but here let's see what they have given. The conceptual framework states that an item, which means the definition of an element, should be recognized. So you are giving the recognition criteria from the conceptual framework. That if it means the definition of an element, that means if it means the definition of an asset, liability, revenue, income, expense, you recognize it. Okay, should be recognized if recognition provides. But you have to recognize it only if it provides more useful financial information. If recognition provides it. What is the meaning of useful financial information? You need to break down this into two. Relevant information, faithful representation. Never forget this too. Okay. Again, tutorial note. Let's see what they do. Do not just recite key principles from the conceptual framework. Make sure that you apply these principles to the accounting treatment of the sale-based royalty. The key issue is what is the accounting treatment of the sale-based royalty? This you have to link to the conceptual framework. Not all the principles of conceptual framework. Asset is this, liability is this. No. So now we are moving towards the recognition of the royalty. Okay, we are taking the help of what conceptual framework. So recognition of royalty earned during the year in the statement of profit or loss will help users of the financial statements to assess the Digiwire's economic performance. What would it do? It will help the financial statement to assess their economic performance and thus make an investment decisions. The sale made in the year can be accurately measured, and so the royalty can be measured calculated. So can be accurately calculated because the sales that you have made this year that you can measure accurately. So royalty based on that, definitely you can calculate that as well accurately. So that's why this is a faithful representation of the income earned in the period. It is possible. That is a faithful representation. We are faithfully representing what actually happened. Okay. Now, future royalty income relating to year 2 or 3. Now we are talking about the other two. Okay. What about the future royalty income that are relating to year 2 or 3 of the contract? This you should not recognize. This should not be recognized because Digiwire has not yet performed in those economic period. Performance they have not yet done. They still didn't make sales for those 2 years, so you cannot recognize the royalty also. Moreover, future royalties cannot be measured with any uncertainty. Number one, no certainty is there. Okay, and so estimation and recognition of this would not provide. So if you try to estimate that in future royalties will be like this and then recognize it, conceptual framework says no, it's not allowed. Why? No faithful representation. It provides no faithful representation of revenue because you're just estimating. You still didn't earn the revenue, so no use of recognizing the royalty. It's not a faithful representation. So the principles in the conceptual framework relating to the recognition are therefore consistent with the approach taken by Digiwire as well. They're consistent. That means they are going in hand. Let's see the approach of Digiwire. Yes, they also recognize this year. They did recognize year 2 and 3's revenue. So it's correct. Moving to requirement number B. For that, we have to read the scenario. We didn't read the scenario. Just investments in Digiwire, then pension plan. Okay, pension plan is the last requirement, so that will leave it for the last. Digiwire has agreed to work with tech game company to develop a new music platform. On 31st December 2006, the company created a new entity, 4D company. Created a new entity. It is known as 4D company. With equal shareholdings. That means more than one shareholding is there. And also they share the profit. That shows there are multiple shareholdings are there. So Digiwire has contributed its own intellectual property in the form of employee expertise, cryptocurrency, okay, with a carrying amount of 3 million, fair value of 4 million. Carrying amount is 3, fair value is 4. And an office building with a carrying amount of 6 and a fair value of 10. Okay. So what are those intellectual properties that they have? One is employee expertise. They didn't place any value on this employee expertise. Cryptocurrency, yes. Office building, yes. Now, the cryptocurrency. This has been recorded at cost in Digiwire's financial statements. In Digiwire's means individual financial statements. It is recorded at cost. Tech game company has contributed the technology and marketing expertise. So the board of 4D will compromise directors appointed equally by the Digiwire company and tech game company. Decisions are made by a unanimous board. No standard it has not mentioned any standard, but you still need to identify which standard it is. There are some words, keywords, which will help you to know which standard it is. Number one, equal shareholding is one word. Okay, sharing the profit. Okay, appointed equally, unanimous board. All this says it is what? Joint arrangements. So joint arrangements. IFRS 11. In joint arrangements also there are two things that you need to identify. Then only, because accounting is different for both. One is whether it's a joint operation. The other one whether it's a joint venture. This you need to identify very correctly. If it's a joint venture, I is 28. If it's a joint operation, IFRS 11 only. So let's see the answer. First of all, 4D company, how they should have been accounted for. Okay. Make sure that you know the definition of joint control, because this principle is regularly tested in SBR. Okay. So with standard IFRS 11. IFRS 11 is joint arrangements. So this defines joint control. So how do you start this answer? You start by defining joint control. What is joint control? Don't immediately say this is joint venture, or don't immediately say this is joint operation. Before that, define joint control. So defines joint control as a contractually agreed sharing of control. Control is shared, not one person is having control. If one person is having control, that is not known as joint control. That is known as subsidiary. Okay. The sharing of control of an arrangement, which exists only when decisions about the relevant activities require the unanimous consent. This is another keyword that has to be there in your answer to say that it's a joint control. One is sharing of control, contractually agreed sharing of control, not just sharing of control. There has to be some contract that says they're sharing control. The other one is unanimous consent. So number one is this keyword, number two is unanimous consent. If these two are there, it's a joint control of the parties sharing the control. This would seem to be the case with 4D company, because decisions are made by unanimous vote of the two parties that share the control. So in this case, 4D is a joint arrangement. So you have to link like this with the company in your scenario, that this is the case with this company, therefore because it has unanimous vote. Okay, so therefore its joint control is there. Now second paragraph, operation, joint venture. Joint operation, joint venture, what is it? Because joint arrangements also two types. This is a joint venture. The investment in 4D, write it clearly, the investment in 4D would seem to qualify as a joint venture. Don't just say it's a joint venture. Give reasons. So it's like you are giving a point, you are giving a reason. Point, reason, like that. This is because 4D is a separate company, isn't it? They told that they have opened a separate entity. So the ventures have rights to the net asset of the arrangements. That's why it's a joint venture. If it's a separate company, it's a joint venture. If it's not a separate company, it's a joint operation. These two things has to be there. Number one, separate company. Number two, right to assets or right to assets or liabilities, or right to net assets. If it's right to net assets, it's a joint venture. These two things has to be there for it to be a joint venture, and both the things are here in this case. Therefore, this is a joint venture. Okay, and remember, accounting treatment of joint venture is the same as accounting treatment of an associate. That's why it is dealt under IS 28. You have to refer to that standard also. Okay, and you also have to say how it will be accounted for. So the joint venture accounts for investment in a joint venture using the equity method. You have to mention that this will be accounted using equity method in accordance with IS 28. Okay, now you're telling whether they are correct or not. Why? Because in the individual financial statement, they have recognized it at cost. So this means that the investment is initially recognized at cost. Yes, because what do we do in equity method? We initially recognize it at cost, whether associate, whether joint venture. Okay. So the venturer will subsequently recognize its share. Subsequently means later, the joint venture will recognize its share of the joint venture's profits and other comprehensive income. Initially at cost. Subsequently how? What is their share of that profit as well as the other comprehensive income that they will recognize. Coming to the derecognition of an asset. Okay, same thing only, same paragraph. Okay, they told derecognition and also what is the profit on that disposal of that asset. But before that, derecognition of an asset. Okay. So according to the conceptual framework, this is just in the tutorial note. Okay, I'm just going for your understanding purpose. You don't have to write this in the answer. This is not there in the answer script. This is from the examiner. They are giving you hint what is discussed in the answer below. So according to the conceptual framework, assets are derecognized when the entity no longer has the control. Correct. Liabilities are derecognized when there is no obligation. So in your case study, you have to see, do you have the right or did you lose the right? So Digiwire has exchanged non-monetary asset. What did he exchange? Non-monetary asset. Is it monetary or is it non-monetary? Matters a lot. So it's a non-monetary asset for its investments in 4D. And thus they need to derecognize the asset. So they need to derecognize the asset. It is contributing to 4D company. What is the carrying amount? 6 million of the property. Just let me take you back to the question again, the scenario again. There are 3 assets which are there. If you go, okay, I will highlight it for you. One is employee expertise. Nothing has been given, so we are not talking about this. The other one is cryptocurrency, that we'll talk later. The other one is office building. So this office building, we can know how to do. One is, this is the carrying amount and the fair value is 10 million. So now we're talking about the office building. Okay, then we'll talk about the cryptocurrency. Just look at the cryptocurrency is 3 million and 4 million. Okay. So that's why the carrying amount of the property is what? 6 million. That carrying amount is derecognized. Because we're exchanging now non-monetary assets, so derecognize it. But the intellectual property of Digiwire has been generated internally. The intellectual property means that employee expertise. What is it? That is generated internally, that employee expertise. You didn't purchase it somewhere else. You didn't purchase those employees from somewhere else. Internally it is there. So, and they do not have a carrying amount. Therefore, that's why they do not have a carrying amount. You cannot have a carrying amount. How will you put an amount for your expertise? If I have this much of knowledge, let's say, okay, I have 10 certificates in this field. I'm so knowledgeable. I have 10 years of experience. How do you put a value for that experience and the skills that you have? You cannot do that. Unless you are taking it over from someone, another company, then there's a value. Okay, you do not. So, and so they do not have a carrying amount. What about the cryptocurrency? See, all these 3 are non-monetary assets. Okay, in one paragraph only you can write it. rather than writing 3 separate paragraphs. The reason is because it comes in one line. Try to group together if you can group together things. For example, this paragraph it only talks about non-monetary asset. How do you derecognize? So non-monetary asset, intellectual property, that is employee expertise, is non-monetary asset. Property is a non-monetary asset. Cryptocurrency is a non-monetary. All these are non-monetary asset. Okay. Basically, you can take assets. So in one paragraph only you can group them together. Okay. So cryptocurrency is recorded as an asset in the financial statements of Digiwire at 3 million. 3 million is the cost. Okay. And must also be derecognized. So you recognize that cost and then you derecognize cryptocurrency. Please make sure that you go through this today, the cryptocurrency part. I know there are others you will be able to do it because we have been repeating, but cryptocurrency is a new area. Go through it. Okay. Now comes the profit on the disposal. And if you see, the third requirement talks about cryptocurrency only, whether it's financial instrument or intangible asset. But before that, let us first finish the profit on disposal. This is what joint venture, right? Joint venture. So when a joint venture contributes a non-monetary asset to a joint venture in exchange for an equity interest in the joint venture, the joint venturer recognizes a proportion of the gain or loss on disposal which is attributable to the other parties to the joint venture, except when the contribution lacks commercial substance. As such, Digiwire is required by IS 28 to limit the profit on disposal of its non-monetary asset to 50%. Okay, up to 50% only they can recognize. 50% they derecognize. Okay, the one which they have disposed, which that part, that 50% they are going to derecognize, because they are two partners, two person who have the joint control. So 50%, everything 50% divided among the two. Okay. So monetary asset to 50% because effectively Digiwire has already disposed of 50% of the asset contributed to the joint venture. So there are two partners, so everything is divided by two. So you cannot say they have disposed 100%. They can only dispose their proportion only, that is 50%. So thus the carrying amount of the joint venture in Digiwire's financial statements at this one will be 11.5. How 11.5? 6 plus 3, that is derecognized for property and cryptocurrency. 6 million for property, 3 million for cryptocurrency. These are the cost. Okay, we are not taking the fair value yet. We will take the fair value when we have to sell, during selling. Then we are comparing and then we are finding gain or loss. That's the next step. But we derecognize it at cost, not the fair value, the carrying amount. So this should be derecognized. Okay, together when you add 11.5, that means that is the carrying amount of the joint venture that you are derecognizing at 11.5. Because see, of the joint venture means carrying amount of the joint venture means whatever the amount that you're derecognizing from the two companies. Okay, two entities you are putting together in a separate entity, that's joint venture. So the derecognized amount is only the amount that will be the carrying amount of the joint venture. Okay, 6 plus 3, because this will go in the joint venture only as a separate entity, that whatever you are derecognized. Okay, next, coming to the gain or loss. Gain or loss, remember that has to be in a proportion. When you are derecognizing, that you don't have to take divide by 2, because both the parties are giving of their assets. So the whole amount will go to the joint venture, but all the profit and loss that will be shared equally. That's why it has to be divided by 2. So for the cryptocurrency, it is 4 minus 3 because fair value is 4, cost was carrying amount was 3, divided by 2. Same for the property. Fair value was 10, cost was 6, so 10 minus 6 divided by 2. Add both. This is the gain. Okay, you need to compare this with 11.5. Hence, the gain is 2.5. Okay, let's take this value also. Okay, so 4 minus 3, 1 divided by 2, it is 0.5. 10 minus 6, 4 divided by 2 plus 2. Okay, so 2 plus 0.5, gain is 2.5. This will be recorded in profit or loss. Coming to the cryptocurrency, very important part of this video is this part only, cryptocurrency. I don't mind if you haven't watched the other parts, but this part you have to watch. Crypto. Some companies accept cryptocurrency as a form of a payment. However, as yet, cryptocurrency is not widely accepted. It is not yet widely accepted by all the entities. Okay. Now we are talking about the nature of the cryptocurrency. Before we say what type it is. Is it a financial instrument or is it an intangible asset? Before that, we have to understand what is cryptocurrency, the nature of it. So cryptocurrency is not cash or cash equivalent. Why? Because most of the people assume it's cash, no? Why cryptocurrency is not cash? We're receiving it in digital format, so it should be cash. No, it's not cash or cash equivalent. The reason is, as its value is exposed to significant changes in the market value and there is no contractual right to receive either cash or cash equivalent. Do you have the right to receive that cash? For example, your receivables. You paid on credit. So from your customer, you have that right, contractual right, that you're going to receive the cash. Whether customers are able to pay you or not, that is not the issue. That is another separate thing. But at least you have the right to receive that cash from your customer. That's why that receivable is taken as cash or cash equivalent. It comes under that. It's a financial asset, right? Here, this cryptocurrency, you don't have any right to receive that cash or cash equivalent. Do you have? No. And also the value is exposed to significant changes in market value. That means the value of the cryptocurrency is dependent on the changes in the market value, and it's very significant. It's not very small amounts, very significant. That's why it cannot be taken as a cash or cash equivalent, because these are the features of cash and cash equivalent, the properties of cash or cash equivalent. Remember in your IS 7, what is the definition of cash or cash equivalent? The value should not be significant. That means the value should not be exposed to significant changes in the market value, as well as there should be a contractual right to receive cash. Both of these are not satisfied, so it's not a cash or cash equivalent. So therefore, cryptocurrency does not meet the definition of a financial asset according to IS 32. It's not according to IFRS 9, it is according to IS 32. There are three standards dealing with financial instruments: IS 32, IFRS 9, IFRS 7. IFRS 32 talks about the presentation. That means financial asset or financial liability. IFRS 7 talks about only the disclosure. IFRS 9, the main standard, that deals with everything. How financial asset is derecognized, how financial liability is recognized, how it should be, how financial asset is impaired, all those things. But here it is IS 32. Okay, definition of financial asset or liability is dealt under IS 32. I have made a video on IS 32. Go watch out that video if you're not sure with your concept of financial asset and all. Okay, just don't mean the financial asset. To meet financial asset, it should meet this cash or cash equivalent definition. Financial asset means what? Cash or cash equivalent. For example, your receivable, your cash, all those things are financial asset. Next, is it intangible asset then? Sometimes it could be that neither it's intangible asset nor it's financial asset. But very rarely they give you such questions. Okay, if they ask you whether this or that, it should be one of it. That's what my experience is. So it should be intangible asset because it's not financial asset, but you should know the reasons. Okay, don't just say okay, it's not financial asset, so it's intangible asset. No, no, no. Your approach should not be like that. Your approach should be how we reach to that intangible asset through some definitions or something. So IS 38 defines intangible asset as what? Identifiable non-monetary asset without physical substance. You cannot touch it, you cannot feel it, and also non-monetary. So cryptocurrency, we already saw in this paragraph, it's non-monetary, right? Non-cash. And also no physical substance. Can we touch it? No, we cannot touch it. So no physical substance, not identifiable. Therefore, this would seem to meet this definition. So that definition they are meeting, the cryptocurrency. Okay. So now third paragraph should be how you're going to recognize, how you're going to measure, how you're going to present, how you're going to disclose, relating to what? Intangible assets. So you have to use the rule of IS 38 now, because you told that it means the definition of IS 38. And limit your answer to cryptocurrency, not general answers. That means you have to talk about amortization, you have to talk about impairment, you have to talk about fair value, where will the changes go, profit or loss, other comprehensive income, all these things will be in this paragraph. Okay. And also you have to talk about where the profit and loss will go. So for that we have this many paragraphs. 2 extra paragraph is for that. If the cryptocurrency is to be recognized as an intangible asset, then it could be measured at this. Because intangible assets, what do we measure it at? Cost less amortization and impairment. We have to deduct amortization and impairment. Next, useful life. Because we talked about amortization, so we have to talk about useful life. That's the next life. So if the useful life was determined to indefinite, that means you cannot predict the useful life. Then no amortization should be charged. Okay. Because there is an active market for the cryptocurrency. Second thing is, this is only if it is measured at cost, but it could be measured at fair value also. But there are some limitations when it comes to intangible assets, whether to measure it at fair value or not. You can only measure it at fair value when there is active market for it. Because intangible assets, we do not have active market. And for cryptocurrency, do we have an active market? Yes. So because there is an active market for the cryptocurrency, yes, cryptocurrencies are dealt something in market in high frequency. So there's an active market. So it's possible for it to be measured at fair value instead, right, rather than cost. So if measured at fair value, now you're changing it to fair value from cost. If measured at fair value, then any gain on remeasurement would be presented in other comprehensive income. This is the rule according to IS 38, that fair value gain will be recognized in OCI. And that gain will not be reclassified through profit or loss when the cryptocurrency is derecognized. It is an asset, no? Cryptocurrency, when you're derecognizing that asset, that means when you're selling this cryptocurrency, when you are selling that asset, that gain or loss will not be reclassified to profit and loss. It will be in other comprehensive income only. This is related to intangible assets. Okay. Make sure that you cannot start immediately by saying fair value. You have to go through all the steps. You have to talk about the cost and all. Because we don't know from the scenario. It's not clear cut. If it was clear cut, then you don't have to say both the things. But here you have to mention both the things. If it is measured at cost, it would be like this. But according to this, the active market is there. So measure it at fair value, and it should be turned measure like this. So all the steps has to be there in your answer. Because in the scenario, it's not clear cut. If they told that okay, it is measured at fair value only, then you don't have to talk about cost at all. Don't waste time talking about cost. Then immediately you can say it is measured at fair value, hence it will be like this, like this, like this. Now, moving to the conceptual framework, we have to link to the conceptual framework, right? And conceptual framework, when do we have to use? When there is no IFRS standard that gives guidance and all. But here we have the standard IS 38. So it will, oh yeah, it is related to cryptocurrency, right? So we have to refer this to the conceptual framework. Okay. Because there is not a separate standard for cryptocurrency. We are just assuming that it's an intangible asset and hence using IS 38. Okay. So when offered a choice of measurement base, the conceptual framework states that consideration should be given to the characteristics of the asset. When you have that choice, it's not that whatever you wish, okay, I am liking this more than that, so I will choose. No, no, no. Characteristics of the asset, you have to see. and the way in which it contributes to the future cash flow. So cryptocurrency has a volatile market value. Market value is so volatile that it keeps changing, and it is often traded in the short term also. So as such, a current value measurement such as fair value is likely to provide more relevant information than a historical cost. Now we are justifying this here. Okay, fair value will be more relevant here than historical cost according to conceptual framework also. Next, the last, this big paragraph. Okay, just in case again we'll keep on referring it. Okay, so question was asking financial or intangible, that we answered. Now fair value, whether it should be recorded in profit and loss account, we are answering this part now. Okay, in the last paragraph, whether it should be profit or loss. So to tell that whether profit or loss, you have to talk about the features and all. Okay, so what the conceptual framework says, they say that profit or loss is the primary source of information about economic performance. Whenever you look at the profit and loss account, you tell me which item will you look at first. Your preference should be always to the profit and loss. What is the profit? Rarely people go and look at other comprehensive income, right? It is first and foremost the profit. That is the primary source. Okay, and that income and expenses would normally presented in the statement. Normally everyone assumes whatever income and expenses are there in the profit and loss. Okay, what about the income and expenses in other comprehensive income? So if the income or expenses might be presented in other comprehensive income, okay, if they can be presented if they result from a current value measure remeasurement, okay, usually when there are some fair value changes and all, that we normally present in other comprehensive income, not only in IS 38 but according to other standards also. Okay, and if presentation in other comprehensive income increases the relevance of profit or loss, that means while presenting it in OCI, it increases the relevance of profit and loss account, then you should recognize it in OCI. Okay, that's what they are saying. But now after this were all general up to this much, now we are referring this to cryptocurrency, how this should be recognized, profit or loss or OCI. However, if cryptocurrency is held in as if cryptocurrency is held as an investment, then economic returns earned in the period are likely to be of interest to the investors. If you're holding this as an investment, investors want to know the return. They are likely to be interested in that. It is of interest to the investors. Therefore, so when assessing the overall economic performance, therefore, gain and losses on remeasurement of the cryptocurrency to fair value should probably be recorded in profit and loss. First of all, the nature is so volatile. So if they are making any return on it, investors will be very much interested in that. So investors will look for profit and loss account rather than OCI. So based on this, should be recorded in profit and loss. Okay. And this treatment would be consistent with financial assets held for in the also with IFRS 9. How? This would be consistent with financial assets held in the short term. So when you're holding the financial assets in the short term, there also what do? You recognize it in profit and loss account, the gain and loss of the remeasurement to fair value. Same like here. Okay. According to IFRS 9. So now we are moving to amendments to IS 19. Employee. And this is the current issue, okay? Current issues will come in every SBR exam, but this is a latest current issue. You will get a current issue, okay? We have to read the scenario for that, part C. What could be the impact and also reasons for that change and calculation to discuss why they change calculations and all. Okay, so since they have given you the figure, calculations you have to do. Digiwire provides a defined benefit pension for its employee from 1st of September 2006. They decide to curtail the plan and to limit the number of participants. The employees were paid compensation from the plan assets and some received termination payments due to redundancy. The monthly service cost calculated using assumptions at the start of the year is 9 million. Okay, this is the monthly service cost. The monthly service cost calculated using assumptions at 1st of September 2006 is 6 million. This is at the start of the year and this is at 1st of September 2006. The relevant financial information related to the plan is as follows. So net deficit and discounted you are given 1st of Jan, 1st of September and 31st December 2006, 30, 36 and 39. So first of all, we start by giving reasons for the amendments and then we calculate to show the changes. In what? One is net interest, the other one is current service cost for 3 marks. To show the changes, remember, always you have to do things. One is before, one is after. Show the impact before, that means calculation before and then after. So before the amendment, IS 19. This is also latest, so make sure that you watch this part as well. After cryptocurrency. So before the amendment, IS 19 did not require entities to revise their assumptions for the calculation of current service cost and net interest. It was not asked before, but now you have to do that. Now you have to revise the assumptions for the calculation of current service cost as well as the net interest during the accounting period. Even if an entity remeasured the cost, net defined benefit liability or an asset in the event of a plan amendment, curtailment or settlement. If you are making this in the event of these 3 things, then you have to revise your assumptions now, currently. Before it was not like that. Okay, so the calculation of the current service cost and the net interest were based on the actual assumptions as at the start of the financial year, even though more up-to-date assumptions have been used when calculating the amendment, curtailment or settlement. So the board felt that it was inappropriate. You have to remember, you are giving reasons why they are amending, why they have amended that you have to revise assumptions or not. Before it was not like this, so now you are giving reasons here. The board felt that it was inappropriate to ignore these updated assumptions. Earlier, they ignored. They based everything on the starting. Okay, at the start of the financial year, if they have assumed that this would be this current service cost or this would be the net interest, they go by that only. But let's say in the middle of the year, some of the employees are leaving. Okay, then what? Then your current service cost might change, net interest will change, but we don't change it. We keep as it is. That what we have assumed in the beginning of the year. Now it is updated in IS 19. Right? Because they felt that it was inappropriate that earlier they were ignoring these updated assumptions. Therefore, now IS 19 was clarified. So now when a plan amendment, curtailment or settlement, you are amending it, you are changing the plan. Curtailment means employees are leaving. Okay, that means current service cost and all will change. Settlement means settling and all. So in these 3 situations, you must revise your assumptions now according to the latest amendment, the latest change. Okay, so now when a plan amendment or settlement occurs during the annual reporting period, an entity must do these things. These 2 things. One is related to the current service cost, the other one is related to the net interest. Okay. So determine the current service cost for the remainder of the period. How do you get that current service cost for the remainder of the period? After the plan amendment, curtailment or settlement, using the actual assumptions used to remeasure the net defined benefit liability asset, reflecting the benefits offered under the plan and the plan assets after that event. After that event, whatever the changes whatever the changes that have happened, you are taking that into the account. Okay. Net interest for the remainder of the period after the plan amendment, curtailment, or settlement using the net defined benefit liability asset reflecting the benefits offered under the plan and the plan assets after that event. This things is repeated from this, all these lines and all. Okay. Second, the discount rate used to remeasure the net defined benefit liability asset, because now it will change. You have to remeasure that. Whatever the benefit liability asset you will have at the end of the year, now you have to change it based on your change in the plan. So discount rate also you might have to change. Coming to the impact of the amendment. What is the impact? You have to calculate here. That means calculations. Without the knowledge of the examinable current issue, this part of the knowledge is very tricky, remember. If you're not aware of this change, this is the change in the syllabus, you cannot answer this question. Because it was updated in 2019, that's why in the 2019 paper it's there. And for September 2021 paper also, you will be getting this. You can expect this question. It's for 4 marks. So if Digiwire has not applied, first calculate without applying, then calculate after applying the revised requirements in IS 19, then the current service cost would have been. That's why you are getting 4 marks. 1 mark for current service cost before applying, 1 for after applying, 1 for net interest before applying, 1 for net interest after applying, total 4 marks. Okay. Then the current service cost would have been 108. 12 months into 9. Because they told monthly, so you have to multiply everything by 12. They didn't give you the total value. Into 9 months. 9 million you have assumed in the beginning of the year. Okay. But when you are revising the standard, on the application of the revised standard, the current service cost would be 8 months into 9 million plus 4 months into 6 million. This 9 million in the beginning it's only for the 8 months now. Later on it's 6 months. Sorry, it's 6 million for the 4 months. Let's see this. Okay. If you see here, the master service cost start of the year 9 million. Okay. So January, February, March, April, May, June, July, August. September we are not counting because 1st of September, 8 months. So 8 months into 9 plus 9, 10, 11, 12. For the other 4 months, it would be September, October, November, December. It would be 6 million. Okay. Hence, 96 now. Before it was 108, now it reduced to 96. So there's a reduction in the current service cost up to 12 million. Coming to the net interest component. Similarly, the net interest component also the same way. Before the standard, make sure that you write these terms before the standard, after the standard. You have to write it, because just don't write figures like that, because no one will understand whether it's before or after. So before the standard, it was 900,000 because 3% into 30 million. After the revision, it is this. Okay. We'll go to the figure later from the case study. Just we'll quickly sum this up here. It's 1 million. Did you see it increased? Net interest increased. So therefore the revision has changed the net interest from this to this. It has increased by 120,000. So what is the net effect of both the current service cost as well as the net interest? So the net effect will be to change the remeasurement component by 11,880,000. We'll come to that figure. We'll come to this figure also later. But okay, first of all, let us understand this, and then this, then this. Okay. If you see the net, okay, if you see here, it was 1,020,000. Okay, it was 1,20,000. So you have to deduct 120,000 from there. So when you deduct, no, I'm sorry, not 120,000. Okay, we'll come to that later, but first let's finish this 900. If you see the net interest, so net deficit 3 into 30, okay? But now it's not like that. Now you have to take 3 on 30 for 8 months. After that, you have to take 3.5% on 36 for 4 months. So if you see here, so if you take here, you see, you are taking 3.5% into 36 million for 4 months only. And this one you are taking for 8 months, 900,000, because you have already calculated this 3% into 30 into 8 months. That plus this, which is 1,20,000. So now the net effect. How are you going to get the net effect? Just okay. You're not taking the December figure, okay? You're not using it at all because it is on 31st December, so you're not using it. If it was 1st of December, at least for 1 month you could have used, but that figure we are not using it. So then if we change the remeasurement component, you have to change the remeasurement component. Here it reduced by 12 million. Okay. Here it has increased by 120,000. So 12 minus 120, that means 0.12. Hence this is the change. It reduced by 12 million, it increased by 0.12. That means remeasurement component you have to change by 11.88 million. Okay. Do we have the marking? Yes, we have the marking scheme also. So for first part it was 9 marks. 3 marks you'll be getting for that application of IFRS 15 and IFRS 13. IFRS 15 to non-cash consideration and IFRS 13 to the valuation of the shares. Okay, and then 2 marks for IFRS 9 remeasurement gains. Also including calculations is 2 marks. Okay, then revenue that has been recognized over time 2 marks, conceptual framework another 2 mark. Okay, because that equity was IFRS 9 7%, so that remeasurement gain also 2 marks. Coming to part B, which is again for 9 marks. So in case you forgot everything, it's joint venture and all. So IFRS 11 for discussing and applying it to the scenario 2 marks. Then this derecognition of non-monetary asset and application to the scenario another 2 marks. All your cryptocurrency and property for derecognition of those things. Okay. Then calculation of the carrying amount of the joint venture is 1 mark. You see, you cannot lose even one thing here. Everything calculates mark here. Even if it's just the calculation of the carrying amount of the joint venture, that itself is 1 mark. Imagine if you would have missed this 1 mark and you're failing at 49. Just imagine that scenario. So you cannot miss out anything. Next, discussion of the potential ways in which cryptocurrencies could be accounted at for a fair value. 4 marks. Highest mark is in this area. Together you are getting the 9 marks. Next one, they didn't break it down. They just told that it's 3 marks and 3 marks only. That means discussion for the reasons. You can give 3 reasons. Okay. And second, calculation of the current service cost, net interest, remeasurement component is 3, and discussion of that impact, that it increased or decreased, the net impact is 1 mark only. For calculation 3 marks. calculation of the current service cost and net interest, and remeasurement. Okay, all three, and discussion that you have to increase it or decrease it like this. Coming to the examiner's comment. Part C was least well answered, that current issue, that IS 19 amendments, people were having issue with this. What many candidates did, they avoid it altogether. Because why? They were unaware of the amendments. Even if you are unaware of the amendments, you should have been in a position to critically describe the previous method by which the cost was calculated. At least that you could have done, rather than ignoring it completely. Because according to the previous, before the amendment, you know how it is, right? Whether it is the current service cost or net interest. Okay. And also, even for discussing, you will get marks. Coming to part A. This required a valuation of the equity investment. This is generally well answered. People know that it was IFRS 9, according to that you value like this, like this. Regarding the royalties, okay, you had to link the conceptual framework to support your answer, to support your treatments that you have used for the revenue. Here, what the students did was they focused on the general aspect of the conceptual framework rather than linking this to the royalties. Okay. But here the answer, you have to relate it to the scenario. That's what the question was asking you, not general aspect of conceptual framework, such as the recognition requirement. Coming to part B. Okay, cryptocurrency, joint venture, and everything was asked in part B. Here, very few discussed that the disposal was effectively 50% of the assets contributed. Very few was able to recognize that. That shows your lack of understanding in IFRS 11, joint control. Okay, relating to the part attributable to the other party of the joint venture. Okay, so the final requirement of part B tested what? Whether cryptocurrency should be financial asset or intangible asset, and also asked about the valuation movement should be in fair value through OCI or profit and loss. In this also, answers were weak. And here also, they ignored students. This is surprising, given that there's a technical article on cryptocurrency. Please go today itself after seeing this video and read that technical article on cryptocurrency before you forget. Don't delay for tomorrow, and then tomorrow you'll be having exam finally. And then after the exam, you'll be like, oh shit, I should have read the technical article. My dear, where were you when the technical article was there and you had all this time to go through that technical article? But you just wasted time. It's just one damn technical article that you have to read. I think you just have to spend around 10 minutes, or not even 10 minutes if you are a fast reader. So please go today, read the technical article, and do such questions like this. Do questions of a complex nature and all. Don't always do easy questions. If you're very good in group accounting, don't do group accounting. Do some other questions where you are lacking, where you are not able to perform well. This is the time that you have to improve in your weakness. Okay? Everyone knows their weakness. Don't ask me how will I know my weakness. Come on. Everyone knows where they are weak and where they are good at. You just need to work on your weakness. Okay? So that's it. These are some tips I have told for your SBR in the last coming days. And do take care and best of luck for SBR.